Welcome to the Learning Investor Podcast. Sit back, relax, and take it slow. Curious minds will always find a way to grow. So come along, let's start the show.
Welcome to the Learning Investor Podcast. I'm your host, Orrin Potts. Today we're going to be talking about ETFs. What is an ETF? Why investors invest in ETFs? Running the numbers, we're going to track some history on an ETF I'm using as an example. What's the specific language you need to know and what does it mean? Where to buy ETFs, and I will give a book recommendation at the end. All right, let's get started. So what is an ETF? An ETF is an exchange-traded fund. It's traded on the stock exchange, and it's similar to individual stocks. ETFs are like baskets of assets. So like stocks, bonds, or commodities, they're all bundled together into a single investment that can be bought and sold throughout the trading day. So when we say exchange-traded fund, I wanted to cover what is a fund in the investment world. A fund refers to a collection of money or resources set aside for a specific purpose, and that's often managed professionally. It could be a pool of capital invested in securities like stocks and bonds. So the example for today is the S&P 500 ETF, but I want to talk about what the S&P 500 is. So the S&P 500, or Standard & Poor's 500, is a stock market index that tracks the performance of 500 of the largest publicly traded companies in the United States. So when we say stock market index, here's what I mean. It's a measurement of a group of stocks' performance, and in this case, it's the S&P 500. So it's Standard & Poor's 500 largest publicly traded companies in the U.S. The S&P 500 is considered a benchmark for the overall health of the United States stock market and economy because it's made up of so many of the United States stocks. So you'll oftentimes find professionals that manage mutual funds comparing their mutual fund to the S&P 500 to see whether or not they just beat the market. So why investors invest in the S&P 500 ETF or just ETFs altogether? So number one is diversification. If you remember what I said, an ETF is like a basket of assets like stocks or bonds or commodities. It's a bunch bundled together. A single ETF can hold dozens, hundreds, or even thousands of securities like stocks, bonds, or commodities, and more. So when you invest in an ETF, you're investing in a small piece of each one of those. So it's almost like instant diversification. So number two is they're low cost and low fees. Most ETFs are passively managed, and that just means simply that they track an index like the S&P 500. That means to lower fees than being actively managed on something like mutual funds. They'll also, every time you change out a security or let's say a stock in a mutual fund, let's say they buy one that's in the group and then they sell one and they're turning it over. Every time that happens, you get a fee associated with that. With an ETF, specifically something like the S&P 500, there's not a lot of turnover, so there's not a lot of fees. You will see some expense ratios on ETFs as low as 0.03%. An expense ratio is the annual fee that you pay to own the ETF, and it's a percentage of your investment. So if you had $1,000 in the ETF and your expense ratio was 0.03%, you're going to pay in fees yearly for that $1,000, 0.03% of $1,000. Number three, accessibility and low entry cost. You can start investing with just one share or even fractional shares of an ETF. It's a very low entry point. And you can buy and sell anytime during market hours, which means you can get in and get out very easily. So it's super accessible. It's typically low cost. So for example, here's an example of how this works. If I purchase $1,000 of the S&P 500 ETF, I now own a small portion of equity in each one of those stocks that's in that ETF, which would be the top 500 publicly traded United States stocks, right? So I'm getting a little piece of everything. Here's what I recommend when you're taking a look at ETFs. Track the history. The S&P 500 is great. There's a ton of data because it's been around for a very long time. So track a history. So if you take a look at the S&P 500 and its returns that it would give you on average every year. So if you took every year the ETF has been around until now, and you average out what the return was over each year, and it's going to have ups, it's going to have downs, etc. On average, the average compound annual growth rate is around 7 to 10% after inflation. So that means that if I put my $1,000 into an ETF, it's going to grow by 7 to 10% every year on average. And that is also assuming that any of my dividends, any of my earnings are getting put right back into it. It's going to keep compounding at 7 to 10% every year. And I want to make this very clear. That's on average. You're going to have years that are really up. You'll have years that are really down. But if you go look at that chart, that's a really good rate of return. So here's another example. If I invested $50 a month in the S&P 500 ETF from the years of 2004 to 2024, so 20 years. So I just did $50 a month. I just keep putting $50 a month in there. I would eventually, by 2024, put in $12,650 total, right? The final value of my ETF, what it's actually worth in 2024, even though I put in $12,650, my ETF would be worth $52,268. And that's, again, this is with the dividends reinvested. So since the S&P 500 is made up of the 500 largest publicly traded stocks in the U.S., some of those stocks give dividends. And I'll go over dividends on another episode, and I have an explanation here in a moment. But those stocks will give you dividends on throughout the year. And if you reinvest those dividends back into it, that is what I'm talking about. So this just goes into the amount of time and continually putting money into an investment like this can really add up and start compounding. But it takes time. So you need to start early. This next section is going to cover some of the language that surround ETFs and other investments in general. But it's some of the language you're going to see out there, and I'm going to tell you what it is, and I'm going to tell you what it means. This is going to be kind of rapid fire, but we're just going to go down the list. So index. What is an index? An index is a benchmark that tracks the performance of a specific group of securities. Most ETFs track an index to mirror its performance. Just like our example, in S&P 500 ETF mirrors the S&P 500 index. A security. So what is a security? When I say security, I say it all the time. So securities are financial instruments that represent some form of ownership or a debt or the right of ownership. There's three main types of securities. So you have equity securities, so stocks, which represent ownership in a company. When you buy a stock, you actually own a piece of that company. Debt securities, so bonds, represent a loan made by the investor to a borrower. So anytime you hear bond, that is a loan. And derivatives, financial contracts whose value are derived from other assets like stocks, interest rates, or currencies. I won't go over derivatives in this episode. It will be for another one. When you see NAV, that means net asset value. The per share value of the ETF's assets calculated at the end of each trading day. Expense ratio. So it's the annual fee you pay as a percentage of your investment to own the ETF. So an example is 0.03% means 30 cents per year you're paying for every $1,000 you invest. So if I invest $1,000 in an ETF that has an expense ratio of 0.03%, I take the $1,000 and I multiply it by 0.03%, and that makes 30 cents. That's my fee. That's my expense that I'm paying to purchase that ETF. Market capitalization, market cap. You probably hear this all the time if you're digging around. Here is what this means when you hear market cap. It is the total value of a company's outstanding shares. So here's an example. Here's how you calculate this. So it's calculated by taking the stock price times the number of shares that are out there that are available. So let's just say, so if a company's stock price is $50, so $50, and there are 1 million shares, the company is worth $50 million in the eyes of the market. So the market cap for that company would be $50 million. So that's all that means. Dividend. So when you hear dividend, a dividend is a portion of a company's profits that are paid to the shareholders like you. So many ETFs pass along dividends from the stocks that they hold. So an ETF holds a bunch of stocks. Some of those stocks pay dividends. In turn, you would get the dividends from those, assuming the ETFs pass them along. But when you purchase certain stocks will pay you based on how the company profits. Those are called dividends. To get compounding results with your investment, oftentimes investors will reinvest the dividends. What's cool about most online brokerages is you can select a button that will automatically reinvest your dividends for you. So that just allows for compound growth. Passive versus active ETFs. So a passive ETF aims to match an index. They're typically matching some sort of index, like the S&P 500, which means they don't really have to be managed all that much, right? They're just following a list that's already out there. It's very low touch, and in most cases, low fees. Active ETFs are managed by professionals who are trying to beat the market. So there are ETFs out there that are actively managed by people. They're picking some stocks or some other security, and then they're getting rid of that and picking some other ones. Typically higher fees, but they're out there trying to beat the market. When we say beat the market, I'm referring back to most mutual funds and professionals are trying to beat an index like the S&P 500, right? They're trying to beat that number because that number is representing the overall U.S. economy. And that's not the only one out there. I'm just using that one as an example. So next, AUM, assets under management, the total money managed by the ETF. So a higher AUM usually means that that fund, the exchange traded fund, is more established and also liquid. So liquidity, you probably hear liquidity all the time, or is that liquid? So here's the definition of liquidity. It's the ease of conversion to cash, how easily you can buy or sell an asset or an ETF without significantly affecting its price. So when we talk about liquidity, it is how easy you can get cash out of whatever the asset is. So if it's a home, in most cases, not very liquid, right? Meaning to be able to go through the process of selling your home and waiting and do all of that. With an ETF, it's typically very liquid, meaning I can sell it. If I sell it, it's not going to significantly change the price, and I can get it out into cash like the next day or the same day. So a sector ETF. A sector ETF it's an ETF that invests in a specific sector of the economy. So when we talk about a sector of the economy, that would be like tech or energy or healthcare or AI is probably considered its own sector at this point. So there's ETFs that surround those. I do have one, I believe, in tech right now that I'm investing in. When you see sector ETF, it just means that the group of securities, whether it's stocks or whatever, are aimed towards those sectors. So where to buy ETFs? Brokerages or online brokerage platforms are the easiest to go through. They give you access to the stock market, including stocks, ETFs, mutual funds, and even more. So here's a list of brokerages. I'm not advertising for them. These are just a list of what's online and available to you. There's probably plenty more. So there's Fidelity, Vanguard, Charles Schwab, Robinhood, E-Trade. There's probably a laundry list, more of them, but those are the most popular that are out there. You can go online, set up an account. You can transfer money into that account, and you can use the money in that account to purchase things like stocks or ETFs, etc. It's very easy. It's very accessible. It's actually pretty quick. And I said I would give a book recommendation. I don't get paid by any of this, but this is a book that I have read. I've said on other episodes that, some of the guests that are going to be coming on actually a little bit later will be very passionate. They'll say that this is the best thing out there since sliced bread. Keep that in mind. That happens in books too. So keep an open mind when you're reading investment books. But here's a book I wanted to recommend that is aimed it's honed in on ETFs. It's called The Little Book of Common Sense Investing by John C. Bogle. John C. Bogle was part of the group that founded Vanguard, so he's heavily invested in the whole ETF philosophy. But it's a great book because it helps you understand ETFs, compounding interest over time, or your investment compounding over time. And it talks about some of the values that are in an ETF, right? Why it's valuable, why it seems super steady, at least in the past. The returns have been pretty steady. It's a great book. I'd give it a listen. That's all for today. If you want to reach out and get in touch, if you have any topic you want me to cover or you want to make any comments, anything like that, reach out to me at the learninginvestorpodcast@gmail.com, and I will see you guys on the next one.
Thanks for listening to the Learning Investor Podcast. One step smarter, one thought better. We'll be back soon, you already know. Until next time, that's the show.